It starts with a single notification on a Tuesday morning that most people almost swipe away without reading. A small red banner on a banking app that simply says, "Withdrawal services are temporarily unavailable." And within about 90 minutes, that same message is showing up on screens in every state in the country. Meet Priya, a 34-year-old nurse living outside Columbus, Ohio, who has exactly $43 in cash sitting in her wallet and has not thought about that number even once in the past 6 months. Because, like most Americans, she has quietly stopped needing cash for almost anything. She swipes her card for coffee, taps her phone for gas, and gets paid every other Friday through direct deposit that lands in her account without her ever touching a paper check. On this particular Tuesday, she pulls up to an ATM outside her hospital on a break, taps her card, and gets a screen that simply reads, "Unable to process your request at this time." She assumes it's her bank, drives to a different branch, and gets the exact same message from a completely different bank's machine. By lunchtime, financial news outlets are reporting that a coordinated failure across the shared back-end networks that power the vast majority of ATMs in the United States has taken machines offline nationwide, and that a full restoration could take several days, depending on how quickly the underlying issue, still being investigated as either a software failure or a possible cyber intrusion, can be identified and fixed. This is not as far-fetched a scenario as it might sound, because incidents like it happen on a smaller scale constantly, and almost nobody notices until it's their own bank. In one well-documented case, a piece of core ATM infrastructure serving credit unions across a dozen states simply went dark overnight after the third-party vendor operating it abruptly ceased operations without warning, stranding machines and leaving members without cash access, while banks scrambled to find a replacement provider. In another case, years earlier, several of the largest banks in the country, including some of the most recognizable names in American banking, saw their ATM and online banking systems go down simultaneously over a single weekend. And analysts who studied the outage at the time openly wondered aloud whether the real cause was outdated infrastructure, a coordinated malware event, or something the banks involved were simply reluctant to admit to publicly. Because, as one banking security analyst put it, financial institutions rely enormously on public trust and are not eager to confirm they've been the victim of a large-scale intrusion even when they have been. The reason a scenario like Priya's nationwide outage matters so much, and the reason regulators spend enormous energy thinking about it, is that the banking sector isn't just another industry. It's officially classified as critical infrastructure alongside power grids and water systems, and it currently holds more than $108 trillion in assets across banks, brokers, and other financial firms, which makes it one of the single most attractive targets in the world for anyone looking to cause economic disruption. Regulatory bodies, including the Treasury Department's Office of Cybersecurity and Critical Infrastructure Protection and the Office of the Comptroller of the Currency, actively monitor threat intelligence feeds around the clock specifically, because a disruption to the systems that move money can ripple outward into nearly every other part of the economy within hours. Back in Columbus, Priya starts noticing the ripple effects almost immediately. Her favorite lunch spot near the hospital, a small independently owned diner that has always taken cards without issue, posts a handwritten sign on the door around dinner time explaining that their card processing system is experiencing severe delays because of unusually high transaction volume across the network, and that they can only accept cash until further notice. She doesn't have enough cash to cover dinner, so she drives to a grocery store instead, where she notices something she's never paid attention to before: a small crowd of people lined up at the customer service counter asking for cash back on their debit purchases, more people than she's ever seen there at once. This is exactly the kind of behavioral shift financial regulators have studied closely in recent years, most famously during the collapse of a major regional bank a few years earlier, an event now widely referred to as the first truly digital bank run, where roughly $42 billion was withdrawn from a single institution in a single day, a scale and speed of withdrawal that would have been physically impossible in the era of tellers and lobby lines, driven in large part by depositors, coordinating and panicking together in real time through group chats and social media rather than word of mouth, spreading slowly through a community over days. Regulators who later reviewed that collapse concluded that both the ease of digital withdrawals and the speed of social media coordination had accelerated what would once have been called a bank run into something closer to what one analyst described as a bank sprint. What ultimately stopped that particular crisis from spiraling further was the same institution now working around the clock in Priya's nationwide scenario, the Federal Deposit Insurance Corporation, which was created back in the 1930s, specifically because roughly 9,000 banks failed amid panicked withdrawals during the Great Depression, and which today insures deposits up to $250,000 per depositor per bank. A guarantee that regulators leaned on hard during the regional banking stress of recent years to reassure the public that money sitting inside a bank, whether or not a customer could physically access an ATM that week, remained completely safe. This distinction, between money being unsafe and money being merely inaccessible through one particular channel, is the single most important idea running through Priya's entire week. And it's one that officials go out of their way to repeat constantly during the outage, because panic during an event like this is driven far more by uncertainty than by any actual threat to anyone's account balance. By the second day, Priya starts paying attention to something she genuinely never thought about before, which is just how little cash most people her age actually carry anymore. National survey data collected by the Federal Reserve shows that the average consumer made only about 6 cash payments a month in a recent year, down sharply from 14 just a decade earlier, and that cash's overall share of consumer transactions has fallen to somewhere around 14% of all payments nationally, well behind both credit and debit cards. Younger adults in particular have moved even further away from cash, with consumers in their 20s reportedly using it for less than 9% of their purchases, compared to older consumers, 55 and up, who still average roughly 10 cash payments a month, nearly 5 times the rate of the youngest adult cohort. And yet, somewhat counterintuitively, the same research consistently finds that cash refuses to actually disappear, with the large majority of consumers reporting they carried some cash in their pocket in the past year, and the overwhelming majority saying they have no intention of ever abandoning it completely. A pattern one Federal Reserve economist summarized simply as cash having shown its resilience precisely because so many people, even devoted cardholders, quietly view it as a dependable backup option sitting in reserve for exactly the kind of week Priya is now living through. That backup function turns out to matter enormously once an outage actually starts, because it exposes just how unevenly prepared different communities are for a disruption like this. Older Americans, people with disabilities, and residents of rural communities are consistently the groups most affected when digital payment systems falter, in large part because they are also the groups most likely to already be living in what researchers call a banking desert, a census tract with no physical bank branch anywhere nearby. National data from the Federal Reserve and community development researchers puts the number of Americans currently living in an identified banking desert above 12 million, with another 11 million living in a potential banking desert that could tip over the moment a single remaining local branch closes its doors. In Priya's own extended family, her grandmother lives in a small town about 90 minutes away, where the nearest physical bank branch closed years earlier, leaving the local credit union as what researchers call the last branch standing for that entire community. And during the outage, her grandmother has almost no way to access physical cash at all beyond driving nearly 2 hours round trip, a burden that falls disproportionately on exactly the population least equipped to absorb it. By the third day, engineers working around the clock at the affected financial technology vendor and multiple partner banks report meaningful progress, restoring machines in batches by region rather than all at once, a deliberate strategy meant to avoid overwhelming the underlying network again the moment it comes back online. Cybersecurity teams brought in to investigate the root cause work through a now fairly standard checklist for events like this, ruling out a hardware failure at a single data center, checking for a corrupted software update pushed simultaneously across too many machines at once, and running forensic analysis to determine whether any unauthorized access played a role. The exact same triage process regulators require financial institutions to rehearse regularly through coordinated cyber attack simulation exercises designed to expose gaps before a real incident forces the issue. While that work continues, ordinary life adapts in small, telling ways all across the country. Peer-to-peer payment apps see a noticeable spike in daily transfers. As friends and roommates settle shared expenses electronically, instead of trading cash, employers remind hourly workers that direct deposit continues completely unaffected because payroll runs through the separate automated clearinghouse network rather than through the ATM system at all. And small business owners who had resisted upgrading their point-of-sale systems for years suddenly find themselves fielding questions about whether they can still take a card, a debit card, or a mobile wallet, even if the ATM around the corner is dark. This is, in a strange way, the entire lesson hiding inside Priya's week compressed into a single observation, which is that a modern economy doesn't actually run on any single payment system. It runs on several overlapping systems that rarely all fail at once. And the real vulnerability isn't the failure of any one channel, it's how many people have unknowingly built their entire financial life around only one of them. Government agencies that specialize in disaster preparedness have been saying some version of this for years, almost always in the context of hurricanes, wildfires, or earthquakes, rather than a coordinated financial outage, but the underlying advice translates directly. Federal emergency management guidance consistently recommends that households keep a modest amount of cash on hand in a safe place at home, specifically in small denominations, because during any disruption serious enough to take ATMs and card networks offline, businesses that do manage to stay open often cannot make change for large bills either. That same guidance recommends setting aside enough cash to cover several days of basic needs, maintaining an emergency savings cushion separate from a primary checking account, and signing up for direct deposit for any recurring government or employer payments, specifically because a physical mail disruption during a crisis can delay paper checks for weeks in a way that electronic transfers simply cannot be delayed. None of this is about distrust of banks or digital payments, officials are careful to emphasize. It's about redundancy, the same principle that keeps commercial aircraft flying on backup systems in hospitals, running generators, applied quietly to household finance. By day 5, the unevenness of the crisis becomes the dominant story. Large metro areas with dense branch networks and multiple competing banks within a few blocks of each other adapt relatively smoothly, tellers processing manual cash, withdrawals over the counter even without a functioning ATM behind them, while small towns with only a single remaining branch, often a community development financial institution serving a population banks have otherwise pulled back from, face hours-long lines and rationed withdrawal amounts just to make sure the cash physically on hand in the vault lasts through the week. Financial researchers who study this kind of disparity have found that branch closures over the past 2 decades have hit certain communities dramatically harder than others, with some urban counties losing well over 20% of their branch network in less than a decade, and rural regions in states like Arkansas and across the Appalachian corridor now requiring residents in some areas to travel 20 miles or more just to reach in-person banking services on an ordinary day, long before any nationwide outage makes the problem worse. Priya spends part of that 5th day on the phone with her grandmother, walking her through how to use a peer-to-peer payment app for the first time, so a neighbor with a working car and some spare cash can help cover groceries until the local credit union reopens its doors fully. A small moment that captures something regulators and consumer advocates have been saying for years, which is that financial resilience isn't really about predicting the next crisis correctly. It's about making sure every part of a household's financial life, and every generation within that household, has more than one working path to their own money. It helps to understand just how much invisible machinery sits behind that one plastic card in Priya's wallet, because almost nobody thinks about it until a week like this forces the question. The automated teller machine itself is barely 60 years old, first appearing in the late 1960s as a convenience for weekend cash access, and for decades it functioned as a fairly simple, largely offline device. Today's ATM network is nothing like that. A single card tap at a machine outside a hospital in Ohio typically routes through several separate systems in the span of a couple of seconds, a card network that verifies the card itself, a switch operator that routes the request to the correct bank and the cardholder's own bank, which checks the account balance and authorizes or denies the withdrawal, all before the machine even begins counting bills. Layered underneath all of that is a physical cash logistics operation almost nobody ever sees, armored trucks moving currency between Federal Reserve cash offices, regional vaults, and individual branches on a tightly scheduled basis because a bank branch or ATM only holds enough physical currency to cover a few days of expected demand at any given time, not an unlimited reserve sitting in the back room. This is precisely why, during Priya's outage, banking officials kept repeating that customer deposits remained completely safe. Even as physical access to that cash became temporarily constrained, the money itself was never at risk, only one narrow channel for reaching it. When something disrupts any single link in that chain, whether it's the switch operator, the card network, or a shared piece of software running across thousands of machines simultaneously, the failure can look identical from a customer's point of view, even though the underlying cause might be completely different. Investigators looking into large-scale outages like this one typically work through the same handful of suspects every time. The most common and least dramatic cause is a routine software update gone wrong. A patch meant to improve security or performance that instead gets pushed to too many machines at once and introduces a bug that takes the whole fleet offline simultaneously, the digital equivalent of a single bad batch of parts reaching every factory on the same day. The second possibility is a hardware or data center failure at a shared vendor, which becomes more dangerous every year, specifically because so much of the ATM and card processing industry has consolidated behind a small number of large third-party technology providers, meaning a problem at just one company can now ripple across banks and credit unions that most customers would never think of as being connected to each other at all. The third possibility, and the one investigators are required to rule out first given how seriously financial regulators treat it, is a deliberate cyber attack, ranging from a distributed denial of service attack designed simply to overwhelm and crash a network to a more sophisticated intrusion aimed at financial data or funds themselves. Federal banking regulators have spent years building out exactly the kind of monitoring infrastructure that gets activated in a scenario like Priya's, sharing threat intelligence in real time across banks through information sharing organizations built specifically for the financial sector, and running dozens of coordinated cyber attack simulation exercises over the years specifically, so that when a real event happens, banks already have rehearsed playbooks rather than having to improvise from scratch while the public watches nervously. It's worth pointing out that the financial system was deliberately built with more redundancy than most people realize, precisely because past crises exposed how dangerous it is to depend on a single rail for moving money. Direct deposits and payroll run through the automated clearinghouse network, a completely separate system from the one that powers ATM withdrawals, which is why Priya's employer was able to reassure staff their paychecks would land on schedule regardless of what was happening with cash machines. Peer-to-peer payment apps ride on yet another layer of infrastructure entirely, often settling between banks through real-time payment rails that have expanded significantly in recent years, specifically to give consumers a faster alternative that doesn't depend on either a functioning ATM or a trip to a branch. Wire transfers, checks, and in-person teller transactions represent still other pathways, each with its own separate technical dependencies, which is exactly why an outage that takes down every ATM in the country at once, while dramatic, still leaves multiple other doors into the same bank account wide open the entire time. This layered redundancy is by design, but it only actually protects a household if that household has more than one of those doors unlocked in the first place. And this is where Priya's week keeps circling back to the uncomfortable gap between how the system is built and how individual people actually use it. Small business owners feel this gap especially sharply, because unlike a salaried employee whose paycheck keeps arriving no matter what, a shop or restaurant's daily revenue depends entirely on customers being able to pay them in that exact moment. Thousands of small merchants nationwide found themselves in the same position that week, caught between customers who suddenly had no easy way to get cash and card processing systems straining under a surge of electronic transactions, as everyone who could still pay by card leaned on it harder than usual. Merchants who had card readers but no cash reserve of their own found themselves in the strange position of being unable to make change, even for the customers who did have bills in hand. A small but very real friction point that echoes almost exactly the guidance federal emergency planners give households ahead of hurricanes and wildfires, where officials specifically recommend keeping smaller denomination bills on hand rather than large ones, precisely because businesses running on skeleton cash reserves during a crisis often cannot break a $100 bill, even if they can technically still accept cash at all. On the sixth day, restoration accelerates. Regional batches of ATMs come back online in sequence, first in major metro areas where the underlying network infrastructure is newest, then gradually extending outward into smaller cities and rural regions where older hardware takes longer to reconnect and verify. Banking officials hold a joint briefing confirming that no customer funds were lost or compromised at any point during the outage, that the root cause has been identified and patched, and that additional safeguards are being added to prevent the same failure mode from cascading across multiple providers simultaneously again in the future. Language that echoes almost word for word the kind of after-action guidance. Financial regulators have published following past disruptions, emphasizing third-party vendor risk management as one of the most persistent weak points in the entire system, precisely because so many banks, credit unions, and ATM networks now depend on a small handful of shared technology providers behind the scenes. By the morning of the seventh day, Priya's card works again at the same machine outside her hospital that rejected it a week earlier, and she withdraws $60, more than she'd normally carry, and tucks it into a drawer at home rather than her wallet, a small private gesture more than a practical one. Life around her snaps back to normal almost immediately. The diner near the hospital starts accepting cards again by early afternoon. The line at the grocery store customer service counter empties out within a day. And by the following week, most people, understandably, have stopped thinking about the outage entirely, the same way most people don't think about the electrical grid until the power actually goes out. But something quieter lingers underneath the surface, both for Priya personally and for the country as a whole. The event becomes a case study almost immediately, cited in regulatory reports and industry conferences the same way earlier incidents were, feeding directly into ongoing efforts by banking regulators to strengthen operational resilience requirements, expand mandatory cyber incident reporting timelines, and pressure the small number of core technology vendors that effectively sit underneath the entire ATM and card processing ecosystem to build in more redundancy so that a single point of failure can no longer take down machines nationwide at once. For ordinary households, the lesson lands somewhere less technical and more personal. It isn't really about whether cash or cards or apps are the right way to pay, because the data is clear that none of them are going away. Cash usage has proven far more stubborn and resilient than a decade of cashless society predictions assumed it would be, even as cards and mobile wallets keep growing in parallel rather than replacing it outright. The real lesson is about what happens the moment any one of those systems, the one a person happens to be leaning on entirely without a backup, goes quiet for a week. Regulators spend the months after the outage doing exactly what history suggests they will, because this is far from the first time a financial disruption has forced a rewrite of the rulebook. The FDIC itself is the most obvious example of a crisis permanently reshaping the system, born directly out of the wave of roughly 9,000 bank failures during the Great Depression, and it has been remarkably effective ever since, with the total number of bank failures across the entire country between the early 2000s and today numbering only in the low hundreds, the overwhelming majority clustered in the financial crisis years, rather than spread evenly across the decades. Every major disruption since has added another layer to that same defensive structure. The collapse of the regional bank a few years before Priya's ATM crisis led directly to expanded emergency guarantee authority that regulators used to backstop uninsured deposits within days rather than weeks, and to a wave of new supervisory attention, specifically focused on how quickly digital withdrawals paired with social media panic could destabilize an institution that looked stable on paper just days earlier. Priya's nationwide ATM outage becomes, in the months that follow, its own case study cited in exactly the same way, feeding into updated third-party vendor risk requirements that push banks to prove they aren't quietly depending on a single shared technology provider for a function as critical as cash access, and into revised cyber incident reporting rules that shrink the window banks have to disclose a significant operational disruption to regulators and, in many cases, to the public. None of this happens quickly or dramatically from the outside. It shows up instead as dense annual reports from bodies like the Office of the Comptroller of the Currency, updated bulletins on managing third-party relationships, and closed-door tabletop exercises where bank executives and regulators wargame the next version of exactly what Priya just lived through, trying to find the next weak link before it fails in public. What almost never changes, interestingly, is the basic advice given to ordinary households, because it has proven durable across completely different kinds of crises, financial, meteorological, and technological alike. Federal emergency planners frame it around natural disasters most of the time, hurricanes knocking out regional power grids for a week, wildfires forcing evacuations that cut people off from their usual bank branch, earthquakes damaging the physical infrastructure banks depend on, but the underlying financial guidance reads almost identically, no matter which disaster triggers it. Keep a modest cash reserve at home in a secure place. Favor smaller bills so that businesses running low on their own cash reserves can still make change. Maintain a separate emergency savings cushion beyond an everyday checking account so that a disruption to one account doesn't leave a household with zero accessible funds. Enroll in direct deposit for any recurring income specifically, because physical mail and paper checks are consistently the slowest and most fragile part of the entire system during any kind of crisis. None of this guidance asks anyone to distrust digital banking or to hoard cash under a mattress as a lifestyle, and officials are careful every single time to frame it as basic redundancy planning rather than pessimism, the same unglamorous, faintly boring instinct that leads a household to keep a spare tire in the trunk of a car they fully expect to run perfectly for years. It's also worth sitting with just how unevenly a week like this lands across different people, because the data on banking access makes clear that this was never going to be an equally shared inconvenience. Consumers over 55, who already average roughly 5 times as many monthly cash transactions as consumers in their 20s, absorbed a disproportionate share of the disruption simply because cash was doing more work in their daily routines to begin with. Households already living inside one of the country's thousands of identified banking deserts, disproportionately concentrated in rural counties across the Midwest, the Mississippi Delta, and Appalachia, along with historically underserved urban neighborhoods that have seen branch closures accelerate over the past 2 decades, had far fewer nearby options to fall back on the moment their primary channel went dark. Community development financial institutions, the small mission-driven lenders that federal researchers increasingly refer to as the last branch standing in these areas, carried a wildly disproportionate share of the burden that week, precisely because they are often the only physical financial institution left for miles in the communities that need reliable access the most. None of this is really a story about ATMs at all by the time it's over. It's a story about how much of modern life, quietly and almost without anyone choosing it deliberately, has come to depend on financial technology that works so reliably, so invisibly, that its absence for even a single week feels less like an inconvenience and more like a small crack in the floor of everyday life. Priya keeps that $60 in the drawer for months afterward, not because she expects another outage, but because the week taught her something almost nobody thinks about until it happens to them, which is that convenience and resilience are not the same thing, and that the safest financial habit isn't picking the single best payment method available. It's never depending on just one,